Welcome back to the deep dive. Today we're taking a close look at the Travelers Companies, Inc. TRV, a real giant in the U.S. property and casualty insurance world.
That's right. And we've got some great source material to work with, a detailed research report from Compasscope, plus the Q2 2025 earnings call transcript. Lots to unpack there.
Absolutely. So our mission today, really get under the hood of TRV, figure out their business structure, where they actually compete effectively, and, what's driving their recent performance.
And importantly, what factors are most critical going forward?
Because TRV, it often looks like this single massive entity, but when you dig in strategically, it's almost like two different companies under one roof.
That's a great way to put it. And that tension, that's key to understanding that.
Okay, let's unpack this, starting with the basics. What exactly does TRV do, and, well, how does it make money?
So at its core, TRV is a property and casualty insurer, P&C. They cover individuals, businesses, even government units. And a really foundational point is how they sell this insurance, mostly through a big network of independent agents and brokers. That choice really shapes a lot of their strategy.
Right, the independent agent channel. Compasscope breaks their business down into, three main buckets? How does that split look?
Yeah, three main segments.
Yeah.
The biggest one, their real engine, is business insurance. Think commercial lines. That's roughly 60% of their total premiums.
60%? Wow.
Okay, and this is where they really shine, especially in middle market commercial insurance, covering sectors like construction, technology, also things like commercial property. And they have a strong presence in small commercial, the BOPs, workers' comp.
So the majority, 60%, is this more specialized business-to-business insurance. That leaves 40% for what most of us think of as insurance.
Exactly. The other big piece, about 40%, is personal insurance. That's your personal auto insurance, for your car, and crucially, homeowners insurance.
Ah, homeowners, that's a big one.
It is. And having such a large homeowners book means TRV has significant exposure to catastrophes. Think hurricanes, wildfires. It comes with the territory if you're a major U.S. home insurer.
Okay, so 60% commercial, 40% personal. What's the third piece? You mentioned a specialty segment.
Right, the bond and specialty insurance segment. It's smaller, but important. It's designed for really complex risks.
Like what?
Things like surety bonds,
Yeah.
fidelity bonds, also management liability insurance. That includes D&O directors and officers, errors and omissions, E&O, and the big growth area, cyber insurance. This segment really shows their depth in specialized underwriting.
Okay, so here's where it gets, like you said, really interesting. P&C insurance, it's a tough market, pretty commoditized in places, cyclical. How does TRV actually carve out a competitive advantage, especially if 40% of their business is in that really tough personal line space?
Yeah, that 40% is tough. Their real competitive strength, their edge, comes almost entirely from that 60%, the commercial lines, particularly the middle market.
How so?
Well, they focus on niches that aren't easily commoditized. Think agribusiness, oil and gas, specialized manufacturing. They build deep expertise there. When you know a niche inside and out, it's much harder for a generalist insurer to come in and compete effectively just on price. Like, they're the specialist craftsman in a market where others are just selling in bulk.
So they trade off maybe massive scale for better margins and defensibility in those niches. Does that actually work long term?
Well, the track record suggests it does if they maintain that underwriting discipline. You can see it in their historical results, pretty consistent combined ratios and returns on equity, ROE.
Right, the combined ratio. Just a quick reminder for everyone listening, that's the core measure of insurance profitability. It compares claims and expenses to the premiums collected. Below 100% means they're making money directly from underwriting the risk.
Exactly. And TRV's has historically been strong, which validates that underwriting skill. Plus, their financial strength is helped by a pretty conservative investment portfolio. Something like 90% of their fixed income investments are rated A or higher. That really limits the risk on the asset side of the balance sheet.
Okay, but let's flip that coin. If commercial is their fortress, where's the vulnerability? Where's the weak spot?
It really has to be that 40% personal line segment. It's just intensely competitive, very commoditized, and TRV doesn't really have a structural advantage there.
Why not?
Well, going back to the distribution, that reliance on independent agents, it works well for complex commercial risks. But for simpler personal lines like auto, it's often more expensive and maybe slower than competitors using a direct-to-consumer digital model.
Like Progressive, for example.
Exactly, like Progressive. So you've got that distribution challenge, plus the inherent catastrophe risk from the large homeowners book. That combination creates their main source of volatility.
Okay, this really sets up the comparisons nicely. When you put TRV next to key peers like Progressive or maybe Chubb, what really stands out about TRV's position?
The differences are pretty stark, actually. You mentioned Progressive. They absolutely dominate personal auto, largely because of that direct digital-first model. It gives them structural advantages in cost and customer acquisition that TRV, paying commissions to agents, just struggles to match in that specific auto space.
So Progressive is the lean, mean digital machine in personal lines. What about Chubb? They're another giant.
Chubb is different again. Their big advantage is global reach and diversification. They operate worldwide. TRV, on the other hand, is overwhelmingly concentrated in the U.S. market.
Which means?
Which means their growth potential is somewhat capped by the mature U.S. market, and they're fully exposed to U.S. economic cycles, U.S. regulations, U.S. weather, unlike a globally diversified player like Chubb.
Got it. So the big picture here is TRV has chosen this path of being a specialist. Really strong, disciplined in these U.S. commercial niches, but they give up the digital speed and scale of Progressive in personal lines and the global diversification of Chubb.
That's the strategic trade-off they've made.
Yeah.
And you see it reflected right in their growth strategy.
Okay, let's pivot to that then. Growth strategy. How are they planning to grow while sticking to this disciplined underwriting approach?
Oh, the strategy really rests on three main pillars, you could say. First is doubling down on that commercial lines dominance. They're putting resources into those high-value specialty areas we talked about, construction, energy, etc. Basically grow where competition is maybe less intense and the margins are better.
Makes sense. Play to your strengths. And what about the investment side? You mentioned their conservative portfolio. With interest rates having moved up, that must be a factor.
Oh, absolutely central. The second big driver is net investment income, NII. Because their portfolio is high quality, mostly fixed income, they're really well positioned to benefit as older, lower-yielding bonds mature, and they reinvest that money at today's higher interest rates.
So that provides a nice tailwind to earnings.
A significant one. It's fairly predictable, high-margin income. Looking at the Q2 call, they projected NII would keep climbing, maybe hitting around $805 million after tax in Q4 2025 alone. That's serious money.
Yeah, that NII growth can definitely cushion things if the underwriting side hits a rough patch. But they still have to deal with that 40% personal lines segment. What's the strategy there? Just keep hiking rates?
It's more about stabilization and profitability than just pure growth. So yes, continued pricing actions, rate increases are part of it, but they also mentioned strategically relaxing some of the restrictions they had put on writing new property business.
Ah, interesting. So they feel they've gotten the profitability back in line.
It seems so. They want some incremental revenue growth there, sure, but only if it meets their strict profitability hurdles. They're not chasing market share at any cost in personal lines.
Okay. So when Compasscope analyzed this overall strategy, what was their take? Is it achievable? What are the risks?
They see strong long-term profit potential, mainly because that commercial position is so well entrenched, and the NII tailwind is pretty reliable. So the commercial growth goals look solid. Yeah. But the personal lines growth part is much more uncertain. Again, it comes back to that distribution model disadvantage against the direct writers. And the big external risks are always there. The potential for P&C pricing across the industry to soften. Eventually, that's just cyclical dynamics and, of course, the ongoing threat of major catastrophe losses.
Right. Okay, given all that context, let's talk execution risk. They seem pretty solid fundamentally, especially after those Q2 numbers we'll get to. But where do the analysts see the biggest potential pitfalls in actually executing this strategy?
Compasscope pegs their overall execution risk as moderate, which sounds about right. They get some insulation because of that expertise in the defensible commercial markets. When 60% of your business is well managed and profitable, it gives you a buffer.
So the risks aren't necessarily about internal fumbles, but more structural or external things?
Largely, yes. The main contributing factors identified are, 1, those inherent catastrophe risks from the property lines, homeowners, and commercial property. That's just part of their business model. 2, the U.S. dependence. Being so reliant on one mature market means they're fully exposed to any U.S.-specific economic downturns or regulatory changes.
Unlike Chubb with its global footprint.
Exactly. And third, crucially, is the competitive pressure in personal lines. That reliance on independent agents means customer retention can be tougher, especially for price-sensitive auto insurance, compared to the direct-to-consumer companies with slicker digital experiences.
So if you compare their execution risk profile to peers, how does it stack up?
It's an interesting comparison. They clearly have less international execution risk than Chubb, simply because they aren't really playing in that complex global space. But the flip side is higher U.S. concentration risk. Compared to, say, Allstate or Hartford, who are maybe more exposed to the ups and downs of the U.S. auto market, TRV likely has lower commercial execution risk due to their specialty focus. But again, they probably have higher personal lines execution risk than Progressive, because Progressive's model is just built better for that specific segment.
So that specialized commercial expertise is really their anchor, their shield against some of these market shocks.
It really is. It provides significant insulation.
Okay, so let's bring this right up to the present. What did all this mean in practice? Let's dive into those Q2 2025 earnings call results. The headlines looked, well, exceptional.
They were frankly stunning. Core income came in at $1.5 billion. That drove a core return on equity, ROE, of 18.8%. Phenomenal number.
18.8% ROE. In insurance, that's huge. What about the core underwriting?
Also very strong. The reported combined ratio improved significantly, down almost 10 points year over year to 90.3%.
90.3. Wow. That really underlines the point about underwriting discipline paying off. They're making good money on the actual insurance risk, even with cat losses factored in.
Absolutely. And if you look at the underlying combined ratio, which strips out catastrophes and prior year reserve development, that was even better at 84.7%.
84.7?
Yeah. And this is a fourth quarter in a row where their after-tax underlying underwriting income topped $1 billion. So real consistency in core profitability.
And the top line, premiums growing.
Healthy growth, too. Net written premiums were up between 3% and 5% across all three segments. And in business insurance, new business production hit a record $744 million for the quarter.
So that commercial engine is still firing on all cylinders. Is the pricing power holding up there?
Seems to be. They reported renewal premium change, basically. Rate increases on existing policies was still strong, 8.6% in the middle market segment, and even higher, 10.7% in small commercial.
And customers are sticking around despite the price hikes.
Apparently so. Client retention was still very high at 85%. And the executives on the call made a point of saying they're actively pricing for social inflation or tort inflation, the rising cost of liability claims. They believe they're keeping margins intact despite those pressures.
Okay. There was also a pretty significant strategic move announced in the quarter, wasn't there? Something about Canada.
That's right, a big one. They announced the sale of most of their Canadian operations for about $2.4 billion.
Why sell off Canada?
According to the executives, it came down to a hard look at where to best deploy capital. They felt the Canadian market was evolving in a way more towards vertical integration, where TRV couldn't really compete effectively or generate the returns they wanted.
So discipline again, cut loose something that doesn't fit the core strategy.
Pretty much. And they plan to use a chunk of the proceeds, around $700 million, for additional share buybacks in 2026. So returning capital to shareholders.
Shows real focus. Okay, one last piece from the Q2 update. How's that personal auto stabilization plan going? Are they making headway against the digital players?
Some positive signs there. The underlying combined ratio in personal auto improved to 89%. That's getting back towards solid profitability. And new business policies actually increased by 12% in the quarter.
Oh, first increase in a while?
First time in over a year, they said. So that's progress. However, the flip side is retention. It's still hovering around 82%. Historically, they'd like to see that in the mid-80s.
So still losing some customers, likely to those digital competitors.
That seems to be the implication. It underscores just how fierce the competition is in that space.
And one final point from the call, they signaled a shift in managing property risk.
They did. Management suggested they expect to start easing off many of the defensive measures they took on property insurance, things like stricter underwriting rules or higher deductibles across most markets by the end of 2025.
What does that signal?
It suggests they feel the pricing actions they've already taken over the past couple of years have worked, and profitability in homeowners and commercial property is getting back to where they need it to be. More confidence.
Okay. So, tying this all together now. Looking forward, the Compass Scope report laid out some key things to watch. If you want to understand if this strong performance, this 18.8% ROE is sustainable, what should you be tracking?
Right. If we connect all these dots, Compass Scope highlighted a few critical factors. Top of the list, number one, pricing trends in commercial lines.
Keep watching those renewal rate increases.
Exactly. Yeah. That 8-10% range needs to hold up. Any significant softening, especially in middle market property or casualty, would directly hit that core 60% of their premiums and profits. That's the main engine.
Right, number one is commercial pricing. What's second?
Number two is that ongoing structural risk, catastrophe loss exposure, and climate risks. Their large property footprint makes them vulnerable. An increase in severe weather events could really hammer underwriting results unexpectedly, wiping out gains from disciplined pricing elsewhere and driving up their own reinsurance costs.
Always a factor for a big property insurer. And the third key?
Number three is claims cost inflation. Are the costs of settling claims, fixing cars, rebuilding homes, paying out liability settlements rising faster than they can raise prices?
Social inflation, construction costs, auto parts, all of it.
All of it. They need to keep demonstrating that their pricing is keeping pace. Otherwise, those great combined ratios we saw could start to deteriorate.
So commercial pricing, cat losses, and claims inflation. Anything else worth keeping an eye on?
A few others Compasscope mentioned. Obviously, investment income. Need interest rates to stay relatively stable or keep rising for that NII tailwind to continue. Also, execution and personal lines recovery. Can they actually improve that auto retention rate closer to the mid-80s and successfully grow bundled home and auto policies against those dominant digital peers? That remains a question mark.
And the broader economy?
Yeah, the macroeconomic impact, especially in the U.S. Things like payroll growth, business formation that drives demand for their core commercial insurance products. A slowdown there would naturally slow premium growth.
This has been a really insightful deep dive. It feels like we've painted a clear picture of TRV. Their core identity really is this highly disciplined P&C insurer. They lean heavily on specialization, particularly in those defendable commercial markets, and use strong underwriting as their main competitive weapon.
Even if it means sometimes sacrificing speed or scale compared to certain competitors.
Which raises a really interesting kind of fundamental question, doesn't it?
Yeah, I think it does. TRV is clearly showing right now that this deep, specialized expertise, especially in less commoditized commercial lines, can generate really superior returns.
Yeah.
I mean, that 18.8% Q2 ROE speaks volumes.
But
the big question is, can that profitable niche strategy, that financial discipline, hold up forever against these two massive competing strategic forces? On one side, you've got the global scale and diversification offered by someone like Chubb. On the other, you have the relentless digital efficiency and scale in personal lines from a Progressive. Can TRV thrive long-term squeezed between those two models?
that really is a core strategic dilemma facing not just TRV, but maybe the whole insurance sector right now. We've seen TRV's strategy hinges entirely on discipline, underwriting expertise, and solid asset management. So looking ahead, maybe the final thought for you, the listener, is this. Over the next 5 or 10 years, what's going to prove more valuable in this market? Will it be TRV's proven, disciplined underwriting skill, or will it be the rapid, digitally optimized scale and reach of its biggest competitors? Definitely something to mull over as you keep an eye on those crucial commercial pricing trends in the quarters ahead. This content is produced by Compasscope.com. For more than 1,100 public listed companies, find detailed research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.